What's going on, guys, and welcome to this session. Today we're going to be talking about trading in the window. Now, overall, this can be taken in a multiple of different ways. Trading within a specific window in price, trading within a specific time window, trading within a window of opportunity. Whatever way you look at this, it's going to hold the same value if you follow the structural and liquidity rules that we have put in place for you prior to showing you this video. Now, of course, if you don't know how to recognize whether you are within a given window, today is going to be the opportunity for you to verify that for yourself and to possibly learn some points that you maybe didn't learn before. So we're going to start off talking about any sort of window scenario that can be established. Okay, now there is no one piece fits all window scenario. Mainly, a window is going to be described as a break or shift in directional bias or a short-term order flow scenario with a matching area of liquidity that you can line up with the same principle. So, for example, you can have structural narrative being built, and it's going to line up with your understanding of what price is doing. Now, the main schematic that we're going to be looking at today is a very, very simple, and every single person that's watching this video would have seen this before, a very, very simple directional movement, okay? This is the key to every single part of the way the market moves, and it is the core of every single trading system out there, whether it's support resistance, whether it's S&D, whether it's trading shapes, whether it's algorithmic trading, whatever it may be. It is always the core of this, and that's why when you first start trading, one of the main things you're going to come across is people talking about an upwards trend, right? Because it's the easiest way to visualize a directional bias for price. When price is delivering like this, there is going to be several windows that are going to be presented to you. Now, depending on what your overall trading bias is, if you were, there's always going to be something for you to trade. And I've mentioned this in our live videos before, that there's always going to be a scenario for you to trade using certain rules. Again, no specifics, but certain rules will allow you to trade every single day if you want to. Now, that does not mean that there will necessarily be a perfect opportunity for you to trade every day, and every opportunity that comes around is going to be different. So understanding that it takes time to build these areas for these windows to be created is a very key part of this. Now, of course, it happens on every single time frame, as we've mentioned before, because the market is fractal. So the first thing we're going to talk about is the window of opportunity that's created when price is traveling in this direction. Now, these windows are simply going to be called 5-minute ranges, and we know about 5-minute ranges because we have taught you them in multiple other videos, including how to track swing points and manipulations within the market, our 5-minute range trading system, how to read major order flow. All of those videos, they all are showing you singular windows that are presented in a pre-established trend direction. Now, each time you create a new range high and a new range low, that is going to be your window for buy opportunities out of this area, okay? That's a very simple way of putting it. We're not here to talk about 5-minute ranges today, though. We're here to talk about the fact that when 5-minute ranges are being given in a certain direction, for example to the upside, it will generally lead you to a higher time frame scenario. And this is where our window comes into principles. Some people may trade off of time basis, some people may trade off of key levels, some people may trade off of structure alone, some people may trade off of liquidity alone. This way of approaching the market is a basis off of all of those scenarios. The only thing that we're not bound by is the time of the day. That's one thing that we're not bound by. We're only bound by structure and understanding of liquidity. So, what is a basic window? A basic window is an area of price that is shown to you, telling you that price is willing to go in a given direction. And then you wait within your parameters for price to deliver this. For anyone that's been watching the live walkthrough videos, you know that we use higher time frame areas to define smaller time frame points of entry. this doesn't mean we're using the hourly to define the 1 minute. It doesn't mean we're using the daily to define the hourly. What it means is as long as you use a time frame that is higher than your entry time frame, you are using a higher time frame to define a trade entry, okay? So the main principle here, if we have a clear point of liquidity within the market, and again, we're going to define how you can find a clear investment within the market, or a origin, as we like to call them. And the lows, in this case, represent the same trajectory, telling you they're coming from the same point. We can begin to utilize what these points mean within the market. Each low is going to be holding a relative amount of the same liquidity. Now, the windows open and close depending on the way price is moving and how price is presenting itself at a given time. Ideally, we would like to use these in conjunction with multiple forms of confirmation, whether you're using a fair value gap, order blocks, highs and lows, support resistance, whatever it may be, the same principle is going to apply. Has the highs and lows that are presenting a move in a given direction held the same characteristics? This is a very key element, because if they do not hold the same characteristics, then they are simply not coming from the same origin. Remember, all of these highs and lows that are presented within this way are related to one another because they are linked through the same origin. The origin is the physical investment that creates a visual representation of liquidity within the market. Understanding that at this point there will be a stage where price has finished taking price higher, and it will eventually want to target the area that money came back in. Now, how do we begin to define this? Well, we begin to define it by tracking the structure properly, making sure that you understand the principles of highs and lows within the market. When our low is taken out, then we can begin to focus on what may happen next. So there is no immediate action taken. Now, of course, there's going to be different trading systems that will tell you otherwise, but it's all down to the case of, would you prefer to learn multiple trading systems partially or one trading system fully? This is the way you have to approach any scenario in trading. Whether you focus purely on this setup or whether you focus on the interlocking nature of these liquid pools, it's completely up to you. The main principle we have to focus on within here is obviously our pre-established trend is going to dictate to us the probability of a movement happening. Now, in this case, we are in a bullish pre-established movement, okay, just for this example. So in this scenario, if a window opens up, it will be a counter trend scenario. This counter trend scenario means that we have limitations within it, and we have to understand that mostly, if the trade validates, it's only going to run to its origin. It's going to go back to where it came from. When we track our highs and lows within a given trajectory, so a directional movement where lows meet a relative area and they show the same characteristics, and these characteristics are the same that we've always said: imbalance, unmitigated order blocks, and overall momentum from each point. We track where the last high has come from. We find the low responsible, and this becomes your latest range, or your SP low and your SP high. Now, SP stands for shift point, as this is a structural point within price where we may see it shift into a different directional narrative. And again, this is only going to be contained within the short-term nature of the structure that we've created. So if we are lucky enough that price decides it wants to break down within here, this tells us by probability that it is seeking the origins in which it came from. Now, in this scenario, we are bullish, so this is a counter move, as I've stated. Ultimately, we are looking for price to validate within here. So how are we going to validate? Well, first of all, we have validated a low being taken in a clearly upwards moving market. We have then identified that the low and high are responsible for moving liquid higher within its current range. We've then broken down. This is where our initial window of opportunity opened. Now, this window of opportunity can work on both sides, sell and buy. So in this case, this is a sell window. A window within price and structure that we would like to see a liquidity basis tell us that we are going to move lower. If we are lucky enough to get this window open, if price delivers back into it, we are looking for a clear narrative that is almost exactly the same as the pre-established move we had before. So how can it be exactly the same? Okay, well, it can be range bound to start. So if we move out of price like so, we have a range high and a range low. If price decides to stay in within this structure, that's completely fine. If it wants to break out and push higher through, that's completely fine as well. The narrative we need to understand is we need to have a clear basis of where liquidity has come into the market, a clear trajectory, so the lows are matching up with relative structural direction, and they hold the same characteristics. Only if this appears within a pre-established window can we take this as anything serious and worth trading. Now, of course, there are going to be times where structure may be subjective due to certain characteristics. There's going to be substructure within major structure that essentially is not going to be counted as a clear structural low. We must make sure that our lows that we are using to validate either the overall sell window itself or the entry within said window are attached to a clear narrative basis. How do we define that? Well, if you have a low, we must make sure that the low before it sits in a relatively similar area in terms of trajectory. It has the same characteristics. Again, follow this back and find your next low. The same procedure needs to happen. You need to validate whether this is actually giving you those criteria, and then the same with the low before. Now, you may not have as many lows as we have in this drawing here, but we need a minimum of 3 validated lows to confirm any form of liquidity trajectory. The reason we need this is because the Institute, if anybody is familiar with Wyckoff, use a 3-drive investment pattern to trigger any given sequence within the market. So whether they're trying to accumulate orders, distribute orders, sell the market, buy the market, regardless of what they're doing, it is always triggered in the same manner. Now, of course, there will be exceptions for this. Nothing happens exactly the same within the market, but they all use the same principles and rule sets overall. So if we validate all 3 of our points, we can say that yes, this window is valid for price to sell out of. If we come back into this window, we need to do the same procedure, finding point 1, point 2, and point 3 of valid structural lows. Now, if you don't know how to validate structural lows, go and check out the How to Read Major Order Flow video. What we need to be focusing on is finding lows that have created new highs. That's the easiest and simplest way to put it, but that video I just mentioned will give it to you in detail and explain it to you from a top-down basis rather than me drawing on a blank space and explaining it to you that way. Once and only once have we validated our sell side scenario. We know that this window of opportunity that has opened up is married and connected to its origins, its roots, exactly the same as we are connected to our relatives, we're connected to our family members. This is exactly the same here. This is the root of this move. Ultimately, price is going to want to get back to here. Now, there is one exception for that statement that I just made there, which is your overall trending direction. So in the example we're showing you here, this is a bullish overall directional bias. So whether we're in a bullish swing range, hourly structure, whatever it may be, overall price is going bullish, which does not mean that you can't trade against that. But what it does mean is it means that we have to understand the limitations and parameters within that smaller time frame narrative. If it is married up and linked to this lower area, it means that your sell side origin or buy side, if it's a reverse of this scenario, is the area that price wants to get to, right? So if we have a clear delivery of low, 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 beautiful, then we break down. It is at that point that you have in turn triggered your entry area. Only once you break down the confirmed low within your pre-confirmed window can you begin to sell into the lows. As we said earlier, this pre-established notion within the market is bullish. So the limitation for us is going to be, number 1, the first origin area that created our validation entry. Secondly, the higher time frame origin that has triggered the validation to even be taken any notice of. So that means if we're entering, for example, here, let's say with our stop above this high. This 1-to-1 scenario here is the first point where we should expect price to go to, and understand that it doesn't have to exceed this level. The reason for this is because short-term grabs of liquidity can continue order flow in its pre-established direction. Now, like I said before, depending on where you are within structure as a whole, whether it's the hourly, 5-minute range, swing range, whatever it may be, this is going to determine the probability of overextending this level. Now, if we come through and let's say we get a nice drop down here, okay, and you go brilliant, protect your position, stop at break even. This trade is only going to run as far as a pullback is willing to go, okay, because this is a pullback trade. Now, most of the time, and you can go back and back test this if you want, you will see price run back to the origin and then it continue to the upside, okay? So the ideal scenario is to establish this scenario, but with a higher time frame pre-established notion of the market traveling down. So let's say you're hitting a higher time frame point of liquidity right here. You create a sell side window with a sell side overall confirmation within. Then the limitations of the trade change, because ultimately you're going to have a higher time frame target that is most of the time far exceeding the short-term liquidity targets within your entry and within the validation area. What are the key elements that we need to be focusing on within this principle? Principle number one is we must confirm our structure. We don't want to be tracking some substructure, you know, non-impulsive, just crappy price action. We want to see clear structural narrative with a clear origin. An origin itself is going to be defined by the area that the volume and momentum picks up from the market and establishes a trajectory that you can actually track. If a high does not establish the same trajectory and it doesn't align with your structural move that you have, then most of the time it's going to be a substructure, or it's not going to be a part of that same liquidity, meaning that that can't be used to validate an entry itself. So what we are going to do is we are going to go down to the live charts and show you some examples of these criteria, which are going to cover the next 2 points before we do that. Secondly, we must assure we understand whether price is bound by a pullback scenario, so in other words, counter our trend scenario, or it is a trending scenario, which means the limitations for it are going to be a lot less restrictive, and ultimately you could see a much larger move come out of it, which is obviously the ideal. But not every day is going to be a trending day. Some days are going to be pullback days. Some days are going to be expansive days. Some days are going to consolidate, right? So you have to adapt for what the market is doing on a given day if the scenarios are given. And thirdly, you have to make sure that you know where the limitation points are within your overall entry criteria. So for example, the first one being the origin of the liquid that you are entering from, and then the origin of the overall move that has confirmed that entry zone in the first place. So it is a multi-time frame confirmation of directional liquidity and structure within a pre-established trending market. Whether it's bullish or bearish, it's going to hold the same principles and the same overall value within. So let's go down to the live charts and I'll show you some examples of this. From there, we will cover some of the setups that have happened over the last couple of sessions and let you learn and pick it up from there. So let's go down to the live charts here. Okay guys, so we're down on the US dollar Swiss franc, and this is a scenario that played out today, this morning to be precise. This is a multi-time frame move overall. We didn't trade this move, but it shows the nature of exactly what I'm showing you here. So first things first, we've established our directional bias with our swing range, which is bullish. Okay, so we understand that any sell moves that happen within these highs and lows are going to be counter the overall higher time frame directional bias. So what did we do? Well, we established our swing high right here. We established our swing low. And we came down and we took out one of the major lows that caused a new high to be formed. Now in this case, we're looking at the liquidity across this basis here, and you can use this low or this low to represent this. Again, whether you're using a higher refined area or you're using this whole area, it's about what the structural movement within price is showing us, not a reaction at a immediate point that we've highlighted. Now, of course, within these areas, so this is a sell side window, so we'd expect price to sell away from here. You can refine order blocks, fair value gaps, refine points within price you want it to react at, and see if it reacts in a given way. But ultimately, it's never going to come in and just drop. You may get some taps in and price play around, but it's going to deliver the same narrative that we have spoke about. So right here we have this window, and we expect price to deliver some sell side moves from it. So what we did was we waited for price to move into this area. If we come down to the 1 minute here, and you will see very, very simply that we establish a clear point that volume picks up from. We have a low into a new high. We have a low into a new high. We have a low into a new high, and then a low into a new high. So we have the origin right here. You can see highlighted there, sell side origin. You have the first low, second low, third low, fourth low. Now, in this case, you could look at this as a multi-point liquidity movement. Main thing that I'm seeing though is that all of these lows, even though they don't line up perfectly with this trajectory, they are all following a relatively steep movement to the upside. They all hold the same structural narrative, and the lows remain the lows. They're not being taken by the previous move coming down. Like this, for example, that's a substructure right there, as it isn't responsible for that high being created. The high is responsible from this low down here. So we come up and we took this high. So remember what this zone is. This zone is a validated area for sell side movements. We had a very clear structural low breakdown here, which gives you a new area to sell away from within your pre-established sell window. If price gets back into here, selling is appropriate. Now, of course, this is a counter move, and I am ultimately waiting for a buy side move. So we only track this for principal purpose of buying from a better area. Where would that better area be? The sell side origin, of course. So price comes up and it takes the SP after a breakdown. So because this is a non-trending move, what are we expecting and what do we see within this? We know that the limitations of price are established at the structural points that are created. If we have structural lows creating a high movement and we are bullish overall, we know that by probability we should not expect anything to overextend past the sell side origin before having either a pullback or before price actually changing directional movement overall. From this point, we'd be looking to sell with our stop above the high, and we're expecting price to react within the origin of the sell side. Price comes down, hits this sell side. Since then, we did have an SP hit here to then run through these highs, but if you look what we did, we came down. No structural confirmation area within here. Price pushed up, hit the origin of that move. It's then come back down, and since then, ultimately, we have been moving sideways. We've had no clear expansion up, no clear expansion down. There is no bias for this price action right now, which is not great, but at the same time, overall, it will develop structure that you can track, and it's already starting to do that across these highs here. This has not put in a new low yet, so we need to validate that. But ultimately, if we were to come up and take this high, we could begin looking for a buy side window to follow price to the swing high. Here again, knowing that this is where we're going to sell from because we're in a valid sell window, we have valid structure to back up the idea of liquidity being moved. Each point has the same characteristics. Even the last point has the same characteristics. And if we're selling, we're only going to trade it to where? The short-term areas of origin. Now, of course, you can hold this trade. If you get into a sell, you can hold it and expect it to run down. But we know by probability that it is not going to do that. Most of the time, it's going to continue trending, as we'd expect, right? We've always said, if price is trending, expect it to continue trending. Main element here, counter trend move, perfectly fine. Understanding the limitations of that counter trend move is the key point here. Remember, this is a super simple structural narrative. It's finding a clearly moving market that holds the same characteristics, waiting for it to form within a pre-established point within price, finding your area of entry, and knowing how far you can expect this to run. Now, of course, this is a much larger time frame down to a smaller time frame, but it works in the same principle. So the second scenario here that we're going to look at is NAS 100. Now, of course, if you want more examples of this with less of an explanation behind it, then head over to the link in the description down below for the playlist of live price lessons, and you're going to see lots of these setups playing out within live price with a commentary to give context. So this was given out this morning to the whole server. If you're not in the Discord, the link is down below. So right here on NAS 100 we have a bullish range, and we actually covered this in a live video that we posted yesterday, which is the 6th of February. Go and check that out and you'll see this scenario that we spoke about, which is exactly the same as we just covered. It's a SP which has been taken after a clear structural narrative has been given. Price delivers back into here and takes a short-term SP, validating our sell move. We then expect to aim for the sell side origin. In this case, we didn't get down to the sell side, but that happens. It's a counter move. What do you expect? So right here you can see price is delivering bullish, and we are overall expecting price to go bullish. So this is a great example of what I was explaining to you guys earlier. We structurally create these lows, we come down and take the SP low and immediately drop down to the sell side origin. At this point, price delivers bullish again. On the way down, it established clear liquid highs. We take our liquid high, which gives us a valid area to look for buys to the buy side origin. In this case, it's a trending move, so chances are we're going to hit that buy side origin and keep expanding if price wants to go to the swing high or further, as it does in this scenario. So what do we do when we get the overall window validated and we know, okay, this now has a potential to run to here in line with our higher time frame bias? We're going to come down to the smaller time frames, which we'll do in a second. We're going to wait for what? A clear structural narrative against our bias to form, highlight our last valid structural point, and at the point that is taken, you have confirmed your buy. Now, whether you buy straight off of that point being hit or whether you wait for a pullback, that is up to you. Again, this is not about entry here, it's about understanding the concept and the rules that you have to apply for it to work consistently. Right here, you can see we had our first run, and I was tracking this. For me, no valid structure there. I'm not willing to get involved with that. Price comes up. Many people at this point would have been walking away going, this is, missed it, whatever, rah, rah, rah. Price comes back in. Look at what it does this time. Clear structural high, clear structural low, clear structural high, clear structural low, clear structural high, clear structural low, with a substructure within here as well. Now, when price takes this high, you have validated going long within this pair using your SP low as your point of protection, using the SP and the window produced as your point of entry, and using the higher time frame liquidity as your target. Now, of course, each window is going to be different in size, each target distance is going to be different in size, each structural move created is going to be different depending on direction, where you are within the range, all of the factors we've covered already. But as long as you structurally confirm that each point holds imbalance and overall momentum, you can see each point here, except for the high. The high is not full of momentum, but each of these highs holds relative momentum. When we take it, we can validate and trade higher through those highs. And you can see here that price actually just takes off massively. So any buy within that region would work great. And what I've said before is if you have a window that has validated a buy side, you don't have to wait for a pullback to then buy it. You can just buy straight off the bat. And like I've said before, go over and watch the videos of the live price analysis, and then you can use this conceptual video to learn how to trade with this principle in the live market. So guys, there are many examples I could go through and show you, but ultimately it's going to be down to you to apply this and practice it. It doesn't mean watch the video, I know how to do it and go and trade it. Follow the rule sets, follow the principles, go to a live market, draw up on your charts, see how it plays out, and begin to track what I am showing you and what we have taught you on this YouTube channel. If you have enjoyed this video and you found it useful, then please let me know. If you do take the time to actually go and practice this, like I say many times, everyone wants to learn how to trade and do systems, but no one's really willing to put the time in and learn. If you do it, you will be able to find these scenarios just like our students do in the Discord server. Please drop me a comment down below and let me know how you got on. Join the Discord and show everyone else your work. But ultimately, guys, it's always going to be down to you to apply this and find how you like to use it and how it works for you. Remembering, every single system in the market, if it's applied consistently, will give you decent results most of the time. The market is subjective, so ultimately there's going to be many ways around this, whether you choose to mix it up with a currently established system, whether you choose to use it purely on its own. Ultimately, like I said, it's going to be down to you to define the best way for you to use this. So if you have enjoyed this video, guys, hit the like button, drop us a comment down below, and I'll catch you all in the next one. Peace.